Along with pensions, ISAs are the basis of what we financial advisors call tax-efficient investment. Both are taxed pretty much the same way on the inside, which means the investments or cash in them grows tax-free. You get a tax break on the way into pensions, but can't get your hands on them if you're a young person until you're an older person. ISAs you can get any time. And ISAs have become popular with both advisors and our clients because, of course, they're tax-free, but also because they've become simple. You can put £20,000 in each tax year and have that in the bank, in stocks and shares, or a mix of both. Diligently using that allowance can make a difference, often not a small one, to your tax bill. And we had an example of this actually a couple of days ago. Someone we saw showed us an unexpected tax bill they'd had, and when we had a look below the surface, they'd actually kept a lump sum of money in a bank account, which was paying a reasonable rate of interest. Now, the banks have to report interest payments these days if they're untaxed to HMRC, and they added it onto his income, which made him a high-rate taxpayer, brought down his allowance, and wham, £2,800 in extra tax, please. Between them, the husband and wife, they could have put £40,000 a year into ISAs, and bingo, no tax bill. So, ISAs, both simple and useful. Making them less simple has not worked very well. There were Help to Buy ISAs, which have gone now because they weren't very popular, and there are still lifetime ISAs. Both were designed to encourage savings to buy a first house. Both in reality actually largely relied on parental money and an understanding of some pretty complex rules, which basically meant that if you don't use it to buy a first house or hold it until you're 60, you lose the tax break which the government gives of 25% on the money you put in. The stats are that over 50% do just that and lose the tax break. So, hey-ho, more tinkering to come. The latest bright idea is that reducing the amount you can have in cash ISAs from £20,000 to £12,000 will encourage more money to go into stocks and shares, which of course it won't. It will just mean that more of that interest will actually be taxable. Could be a vote loser. So it only applies to under 65s. Why? Well, a cynic might say, the over 65s are more likely to vote. And that lifetime ISA is changing too. You'll only be able to use it to buy a first house. At the moment, you could also hold it for retirement, although why would you? And the government bonus will be added when you buy your house. That's 25% of what you paid in and not at the start, so you won't get the growth on it. And of course, it's more likely to be another government's problem, isn't it? Confused? Well, I'm not surprised. My mantra has for a long time been to keep it simple in the advice we give. If saving is to be encouraged, if we really are trying to make the population self-sufficient, to help us to be able to look after ourselves better, tiddling around with stuff that was actually working okay won't help. It will discourage, not encourage, and really won't raise enough in tax to make it worthwhile. ISAs will still be worthwhile, but complicating things still further is not the way, I'd say.